Welcome to ETF Edge, your go-to place for everything exchange-traded funds. I'm Leslie Picker in for Bob Pisani today. Joining us today is Todd Rosenbluth of CFRA and Matt Bartolini of State Street. Let's start with the sell-off continuing today with the S&P, Dow, and NASDAQ all on track for the first negative month of the year and trading near three-month lows. The sell in May theme in full effect as U.S. equity ETFs see roughly $7 billion in outflows just this month. This is investors have been rushing for safety in fixed income, quality, and low volatility ETFs. So just how much worse could the sell-off get, and where should investors go to hide? Matt, we'll start with you.
So, I think where we are in the market cycle with slowing economic growth and slowing profits, investors should really target quality, but don't overpay, because that can provide a little bit of margin of safety if these microbursts of volatility really extend themselves. And
Todd, where do you think investors can see opportunity in the current environment?
Yeah, well, we at CFRA think we're going to see a bounce back in June. That typically has happened when there's been a sell-off like we've had in May historically, but we've seen inflows into quality. Matt mentioned, so the quality ETF QUAL from iShares saw some strong inflows. We've seen minimum or low volatility ETFs like SPLV or USMV see strong interest, and we think dividend strategies are a good place to be able to go. If you're looking at SDY from State Street or NOBL, which is from ProShares, those are good places to be able to hide in the marketplace, get some income, and ride out some of this volatility that we're likely to have during the summer.
Matt, do you agree, sell in May and maybe stick around for some better days in June, as Todd was suggesting?
Well, I think investors should broadly stay invested, just given that we're continuing to have accommodative monetary policies and fiscal stimulus that is likely to continue. So I think what this just tells us that investors are willing to stay invested but move towards more high quality names with sustainable cash flows and high quality balance sheets, because typically in an economic slowdown, those are the type of stocks that tend to outperform.
Todd, in terms of hedging using ETFs, are there specific areas that may kind of counterbalance some of the quality ETFs that you're looking at right now?
Yeah, well, you could also rotate into some of the defensive sectors. Consumer staples, healthcare have historically done well during these periods of time. And you've got ETFs like XLV, the healthcare ETF from State Street. You've got VDC, the Vanguard Consumer Staples ETF. Investors have done well rotating during this volatile periods of time. Instead of hiding in the marketplace, you can be able to do that to hedge out some of the risk that's out there in the market and be able to rotate, not just necessarily retreat from the broader market sell-off.
Matt, do you see people using ETFs more in uncertain environments like these rather than making a kind of specific stock play? They just turn more broadly to ETFs in order to diversify their portfolios a bit more.
Yeah, we continue to see rotations from ETFs. So as Todd was saying, we've seen some rotations within sectors to the more defensive segments, but again, more rotations into fixed income ETFs to really provide that portfolio ballast during times of volatility. We've seen government and aggregate exposures take in assets in the month of May as the equity market sells off. And I think that really just shows the sophisticated and tactical nature that ETFs can provide for clients that are moving in and out of the market based on the latest information.
All right, guys, moving on. It's not just your everyday retail investor that's been flocking to the ETF market. Insurers have also been scooping up exchange-traded funds. Last year, over a third of insurance companies actually used ETFs and held 372 million shares. That's a 7% increase from the year before, even as assets under management actually decreased. Todd, what does this say about overall liquidity in ETFs? This is a really interesting trend that you pointed out.
Yeah, this is some great data that came from S&P Global that we at CFRA have been leveraging in recent weeks. It's really exciting to see the mega cap insurance companies move more aggressively into using ETFs. Now, it's still a very small piece of their overall asset base, and insurance companies are a very small piece overall, but they gravitated towards the more liquid-oriented ETFs. SPY, which is a State Street product, IWM, which is an iShares Russell 2000-based product. We saw HYG, a high-yield bond product. These are products that are focused more from the institutional marketplace that saw strong inflows, net demand during 2018, that's really going to be a confidence booster for investors when they want to be able to get out, to know that there's a large institutional investor that's on the other side of that trade to execute that.
Are you seeing insurance companies invest in riskier areas of the ETF market, maybe those that are less liquid and could potentially pose a systemic risk to some large insurance companies?
No, we don't think that's happening. Where it's going is primarily into the more plain vanilla oriented, market cap weighted equity and fixed income products are the larger ones. What's different about what they're doing than the retail investor is they're focusing a little bit more on trading volume and liquidity than they are on expense ratio, which has been much more popular a metric from retail-oriented investors. So SPY saw strong demand, whereas IVV from iShares and VOO from Vanguard, that all track the same S&P 500 index, they saw less interest from the insurance companies. Again, positive thing for overall investors. They're just using the broader tools that are out there in a market cap weighted way and getting exposure.
Matt, do you agree that this is a positive trend for investors in ETFs to see, large asset managers like insurance companies really entering this space in a big way?
Yes, because by having them trade the ETFs, that's going to increase the liquidity profile for all different investors and lower overall trading costs, which are really an important part of that total cost of ownership. And we're going to see a lot of demand because of regulatory changes where you can now value an ETF as it were a single bond. And this is going to lead to more inflows and more assets being grown within the insurance channel, but within fixed income ETFs, where I think that's the next leg of growth for ETFs within the insurance space.
I was just going to add to that to say we suddenly saw fixed income inflows in particular for the reasons that Matt touched on. And we've seen some of the broadly diversified products tied to the Bloomberg Barclays Aggregate Index, as well as HYG and J&K among some of the more popular products that are being used by insurance companies in 2018.
Are there other asset managers or other areas within the overall markets that you think could provide yet another leg of growth that haven't really tapped into the ETF space yet, maybe like insurance companies a few years ago, that you think could really even help this liquidity and help bring down the cost of trading even more?
Yeah, well, we're seeing a whole host of institutional-oriented investors looking towards ETFs. So hedge funds are using ETFs as a vehicle to be able to do so. Private banking is using ETFs as a vehicle of doing that. For insurance, it's less than 1% of their overall asset base that is currently tied to ETFs. So if that needle can really move, if we have some of these larger insurance companies moving in, that will really drive overall liquidity and make sure that there is an investor on the other side of the trade when a retail investor wants to exit their existing position, instead of having to worry if there will be problems.
Matt, if it's 1% now, how large of a proportion of insurance company assets do you see ETFs really becoming, say, in the next 5 years or so?
Well, I think the rate of growth is going to continue. We've seen a pickup from 2016 to 2018. So as far as the percentage, it's probably going to increase in that linear fashion. So maybe 2, 3, 4, 5% by the time we get 2 to 3 years out, particularly with that growth coming from fixed income ETFs as the regulatory changes have become more appealing to insurance companies.
Well, it'll certainly be interesting to see. Now to one area of the market that is heating up, and that is the deal space. M&A has been a key theme in 2019, with oil giants Chevron and Occidental battling over Anadarko, and Bristol-Myers Squibb buying biotech rival Celgene for $88 billion. And you guessed it, there is a way to capitalize on these mega mergers using ETFs. Joining us now is Saul Bruno, Chief Investment Officer at IndexIQ and Managing Director at New York Life Investments. He is the man behind an ETF capitalizing on recent mergers and acquisitions. So Saul, explain to us how this M&A ETF works exactly.
So it's great to be here. Thanks, Leslie. So M&A is a passive ETF. So we run a systematic or a rules-based process to try to capture as many merger arb deals as we can, with the general idea being the more deals you have, and with the premium and completion rates, you have the opportunity to pick up some of those premiums and deliver valuable returns to the portfolio.
So is the thought here that, because it's systematized, that the deals that are announced will more likely than not close, or do you look at the potential probability for certain deals to close over others, whether it's due to antitrust concerns or CFIUS regulations or other areas that, traditional hedge fund merger arbitrage shops will really kind of pride themselves on focusing on?
So being that it's a systematic process, we expect to have fairly high completion rates, and that's what we're trying to capture here. So if you look at the completion rates, it's actually improved over the last 3 years with this administration. So the cancellation rate has actually gone down. It's somewhere probably around 85 to 90% of the deals are successfully capturing or successfully closing. And so that's really what we're trying to capture there, is the premium associated with those deals by owning approximately 40 to 50 names at any point in time. We're trying to diversify some of that specific risk of one particular deal breaking, but really trying to capture the overall premium associated with merger arbitrage investing.
So is the ETF long the target, or does it also go short the acquirer as well as a traditional merger arbitrage strategy would entail?
So we will go long the target company, and we have a systematic process that we run that would identify the target companies that meet our criteria that get put into the portfolio. Where we differ a little bit is on the short side. So we don't short the acquirer, we actually short the sector of the acquirer, because we're trying to provide broad protection against downside moves related to a specific event in an industry, a sector, or the broad market. So if you look at a day like today, for example, where the markets are down about 1%, even with only about a 35% hedge, it's actually been fairly effective at protecting against the broad downside move. So M&A is actually pretty close to flat on the day.
All right, I think Todd had a question.
Yeah, Sal, just curious from a sector diversification standpoint, it sounds like you've got tech and healthcare and energy as some of the leading ones. Have you seen historically a rotation among sectors in the M&A space?
There is a rotation among time, and you're correct. Those are the three largest sector weights we have currently, financials being another one. Importantly, though, because we're putting the hedges on, so even though we have probably about a 25% weight in technology, we're actually short about 12% on the technology sector. So as we've seen some of the semis come under pressure with the China trade issues and CFIUS, that's actually provided a very good downside protection, again, against that broad down move that's affecting the entire sector.
So is that diversification benefit, is that the advantage to investing in upcoming deals using an ETF rather than just buying the individual names outright, that you do get kind of a broader base of deals that you're looking at to receive those diversification benefits?
Yeah, so for an individual investor, it would probably be pretty difficult to own 40 or 50 deals and then to identify the hedges and to put those on. Clearly doing it in a structure like an ETF gives you that diversification. But then also you look at the additional benefits of the ETF relative to other structures, say a mutual fund or limited partnership type hedge fund. ETFs, the M&A has all of the benefits of a traditional ETF, including transparency, liquidity, and tax efficiency. So that's why we think it's actually the preferred vehicle for a strategy like this.
Good stuff. All right. Thank you so much, Saul, Todd, and Matt. Thank you for joining us today. And that does it for this week's ETF Edge. I'm Leslie Picker. My thanks to Todd Rosenbluth and Matt Bartolini for joining us today. And thank you for watching. You can find all of our latest videos right here on our website, etfedge.cnbc.com. We'll see you next week.
Get the ABCs of ETFs with the ETF Edge newsletter, your weekly update on the hottest trends in the nearly $4 trillion market of exchange-traded funds, expert analysis, actionable ideas, and exclusive insight from host Bob Pisani. Sign up now at cnbc.com/ETF Edge newsletter.